Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the programme where you can have your property related questions answered by our team of property experts. And joining me today, somebody who's become a regular contributor now, Ryan Hughes, founder of the Mr. Investor brand, Buy to Let Experts. Welcome, Ryan.
Thank you.
Hope you had a good trip down.
Nice, easy commute.
Good, well that's great. And joining us for the first time is David Hanna, Chairman of Cornerstone Group, who are property taxation experts. Welcome to you, David.
Thank you. Welcome. It's been a great pleasure to be here.
Good. Hope you had a good trip in too. Yeah. So we'll get straight on with the questioning. And Ryan, you're going first. And it's given that Scotland appear to be bringing a rental cost cap, do the experts think the UK government will follow suit? And if so, what would be the consequences for the buy-to-let landlord?
I hope they don't, but there will be something similar put in place depending on the success. We've seen how Scotland has changed, obviously, the freehold. That's not yet happened in the UK, but is certainly changing that way with the new builds going forward. So from that point, it's been a success, but they've watched people do it before. Maybe we'll see how it goes. I think it's very, very dangerous, especially given the current climate, everything increasing, especially people that have finance on properties with that cost being put onto the landlord. Some of them run it very, very closely, where the rents may just be paying for the mortgage. It will put people over the edge. I think we'll see a lot of people currently already that are leaving the market. A lot more will be leaving.
Do you think that, do you think it's right that government, I'm going to use the word interfere in such matters, or do you think the market really should take care of itself?
I believe the market should take care of itself. The people have them, a lot of our clients, these are businesses. We can't tell people how much they charge for a hot dog or a burger. That's their discretion. That's how they run their business, to tell someone how much they should or are able to charge for their property, because they won't know how much running costs. People may have this secondary source of income to fund another business, to fund their own lifestyle. So I think it's...
Well, I think there's a further issue here, isn't there? We'll talk to David in a minute, who's a pension expert, but we know that we can't put residential properties into de facto pensions as such, but there's nothing to stop anybody having a buy-to-let property as a pension.
Correct.
And where the mortgage repayments do run so close to perhaps the rental received, you know, for a certain period of the ownership, then it's very, very difficult if you start interfering with rental levels, isn't it?
People are doing it. Some of our biggest clients are day-to-day are people cashing in the pensions to keep up with the standard of living for the rising costs. So they need a higher return, especially with the banks, a couple of savings accounts, but even my son's savings account is 0.01, you know. So to say that we're now capping how much you can make from another source, i.e. property, it's crazy.
What do you think, David?
Well, firstly, a correction. I'm not a pensions expert. I'm a property tax expert who's about to be a pensioner. So I guess probably...
Okay, well, that's close enough, I think.
And because I'm about to be a pensioner, secondly, I mean, the history of rent controls in this country and indeed globally have never been good either for the quantity or the quality of available buy-to-let properties. Indeed, in this country, we had those controls up until the early 1980s. And one would fairly argue that the growth in the buy-to-let sector and the quality of buy-to-let properties has actually materially increased in the last 40 years. So do I think it's a good idea? Absolutely not. Do I think that I'll call it the English government, of course, because we're talking about the separate actions of Scotland. Do I think the English government or the government of England and Wales will introduce similar measures based on the current Prime Minister and then the constitution of the Cabinet? No, I don't believe they will do so.
Interesting. I mean, on the point of taxation, it is very difficult, and I've never understood why we can't put residential properties into pensions, and I just don't get it really. I mean, it seems to me such an obvious step.
Yeah, I would agree with you. There are limited ways in which you can get access to what I call residential property yields and returns, mainly through things like called generally diversified commercial vehicles, or GDCVs, REITs and stuff like that. You can invest your pension in those in certain circumstances. But I agree with you, it seems absolutely insane that with so many people relying on buy-to-let property to supplement their pensions, as it were, that we shouldn't be allowed to hold those assets actually inside the pension vehicle.
It does seem that this government, and I'll take that over the last couple of years, has had a little bit of a down on the smaller investor, and they're just making it more and more difficult for that person that owns 1, 2 or 3 properties to invest in buy-to-let. Taxation seems to be slightly more penal, doesn't it? And the regulations seem to be getting hotter and hotter.
Yeah, I would agree. I think certainly from a taxation perspective, it started with the introduction of the 3% second home surcharge in 2016, which was deliberately designed to reduce or prevent, and particularly small-scale investors, from nipping in front of potential owner-occupiers. That was the justification at the time. The other thing, it was supposed to encourage corporate investors. The government wanted buy-to-let operators to be companies. I can't see why that would have improved anything.
Well, if you were cynical about it, you'd say it's because it's easier to collect tax from such bodies, isn't it?
Well, it is, but then again, you see, they then, of course, introduced Clause 24, which gradually phased out higher rate mortgage interest relief for income tax investors. So there was a tax advantage in going into a company. Of course, a cynic might say it's a lot easier to increase taxes on companies without losing votes than it is to increase taxes on individuals.
I suppose so.
But potentially, there seems to have been this idea that corporate landlords were far more responsible than individual landlords. And I'm not sure what Ryan's experience of that is.
Well, I think the interesting thing is we had this business the other week of the government saying, well, they want to crack down on rogue landlords and landlords that don't live up to their responsibilities. And I'm sure if you did a survey, you'd find it's most of the local authorities and the housing associations that are guilty of such breaches and deficiencies. But there we are.
Well, I mean, indeed, and I'm sorry to cut in, but there's one particular authority in the East Midlands, Nottingham City Council, who are hot on selective licensing, but themselves have been reported for failing to meet necessary housing standards.
All right, David, your question. Can the panel help me understand the stamp duty position when buying a commercial building with the intention of converting it to residential apartments? Are there any forms of relief or concessions available?
Well, in short, yes, there are. And let's have a look at what a convertible or a commercial building in the course of conversion or ready to convert would be. Commercial building, quite obviously, commercial rate of SDLT could be up to 5%. However, if the building has planning for permission for conversion or has permitted development rights, then you have the ability on acquisition to claim multiple dwellings relief, provided the works of construction or conversion have commenced.
Right.
And that could bring the rate of SDLT down as low as 1% on that building.
Well, that's a bit of a gamble, isn't it, if you've got to start work before you get the concession?
No, because it's not necessarily that you've done the work, it may be that the previous owner has started the work. So take a typical commercial building, one example that I can recall, where a former hotel was offered with permitted development right for 183 apartments, and the former owner had stripped out a lot of the commercial equipment, the HVAC. I do believe he'd taken the lifts. Right. Rather short-sighted of him, but there you go. And that qualified as
Could be an expensive mistake, didn't it? Yeah. Anyway.
He'd also done some asbestos removal, so in order to improve the value of the building. And well, all of that is part of the works of conversion, because one of the things you have to do on a conversion is strip out to start with. So we were able to get the bill on that one down from, I seem to recall, around 4.8% to 1.3%. Significant saver for the developer investor. And one would hope that some of that saving was passed on in the price of the final units.
Right. That's an optimistic hope, isn't it?
Well,
it's the same with 106 agreements as used to be. You know, people very gaily say, "Oh, well, the developers can afford this; they're all rich." Well, what do you think the developer does? He just adds it onto the price of the building, divides it by how many apartments, and passes it all on.
That's right, and people need to understand. You know, developers don't operate on 30, 40, 50% net profit margins. They often operate on 10% or less, and certainly during the last 2 or 3 years, developers have been hit by increase in raw material supply, supply chain issues, labour supply issues, and yet at the same, yes, they've had to put their prices up. They've been helped by the fact that there's still an undersupply of developed housing and developed accommodation in this country, and that's helped to keep prices moving ahead of inflation.
Okay, well, on that happy note, we'll go to our break now. So join me again after the break when we'll be asking Ryan and David more of your questions. Hello and welcome back to part 2 of Property Question Time with Ryan Hughes and David Hanna answering your questions. So Ryan, your second question. Can the panel explain the expression no-fault evictions? What does it mean and what will be the effect on those who let out their property as small investors rather than the larger corporate multi-property landlords?
I think the no-fault eviction is where a landlord is regaining possession for no fault of the tenant, not where they've not paid rent or they've damaged the property, just purely ending the tenancy for no reason, for the tenant's fault. But for me, the biggest part of that is it's two-sided. It's very dangerous for someone that, I think the biggest issue is landlords trying to regain possession of the property, but you also have a lot of tenants that create homes. I've certainly seen a lot of tenants create the homes and spend their own money on upgrading the properties. So it's that fine line of the tenants that have done work, it's in their interest to scrap the no-fault evictions, but for the landlords, there's still an underlying issue of trying to regain possession of their property.
So does it affect the natural end to, shall we say, an assured short-hold tenancy?
They should be served it at the start, usually, so that can be put in place, but it can be served at any time.
That used to be the Section 21,
yeah.
So you serve that at the point of signing the lease?
Yeah, yeah.
Is that encouraged these days?
I don't believe it is, but I think it's for the tenant. They've got to be very cautious of where they're renting and how much they spend on the property. For me, the biggest point is there needs to be an easier way for people to regain access of the property from the landlord's perspective and not just go, right, okay, we'll scrap that. There has to be more authority for the landlord for reasons of wanting to gain the property back.
Ryan, you're not old enough, but I can go back to the Thatcher days when Margaret Thatcher introduced these assured short-hold tenancies, and I'm sure viewers have heard me say this before, that they were introduced to really get rid of the days of people like Rackman who would use all sorts of means to get sitting tenants out of properties to get the value of the property up and redevelop.
Yeah.
Now, that actually has worked very well on a number of fronts. It's provided extra homes into the rental market, which has been welcome, which I think has saved many a government a problem over housing shortages. But in essence, what it means is that the landlord could be sure, i.e. the assured short-hold, of getting back his property at a particular point, and the tenant knew exactly where he or she stood on the day the tenancy ended. But it seems that this latest government is almost going back on that ethos. And if we're not very careful, we are going to get rogue tenants taking advantage of sitting situations and some rogue landlords trying to get tenants out for no other reason than to redevelopment or let for a higher rent. So it can't really be very good, can it?
I think there's just more support needed for both parties. And that's the issue. They come in and we go, we'll put this in, we'll take this out, and they're constantly changing the market of who has the authority. And the risk keeps changing hands.
Or again, a government that doesn't interfere in the housing market and just lets it go.
Yeah, the big thing for me is, and we've seen it time and time again, if you want to increase the rent, there's certain times where you have them 6 and 12 month points, which work perfect. So as long as the landlord or the letting agent manages the property and keeps making
follows the process.
Yeah, correct. Assesses it every 6 to 12 months, keeping within the correct percentage margins of the increase. Because what's happened over the years is so many landlords have just been, tenant's fine, the tenant's fine. Then all of a sudden they come to sell it and they go, well, it gets 600, but it should get 900, but they've been in there for 5 or 6 years. That's a problem, because you can't just go, right now the rent's 900. So what they have to do is look at trying to get the tenant out to then re-let it to someone new at a higher rate, because the percentage is too high to make that increase.
I suppose in essence we should just try and live with the times. I mean, the assured short holds were brought in probably 35 years ago, and perhaps just things have evolved and we just need new instruments now. I mean, it's often a query that we get. For instance, somebody in an HMO property, the usual instrument to use is again an assured short hold tenancy. But actually, where HMOs are concerned, I know here in Canary Wharf, for instance, you get a lot of people that use an HMO to stay in the week, go home to their home in the country or wherever at weekends. And of course, actually, then an assured short hold tenancy is not appropriate, is it? Because it's not your main home.
Correct.
So perhaps we just need a review of all this stuff now.
I think there's more support needed for both sides. Certainly the landlords at regaining the properties, because they just don't feel supported, and the tenants. So for the price of some bad tenants and some bad landlords, everyone gets penalised.
Yeah. Anything to add to that, David?
I think I agree with both of you, and I speak as somebody who is married to a landlord and the father of a tenant.
Right.
Strangely, but yeah, I mean, I think one of the things I was just hearing you say was that it seems to me that the forms and the lifestyles that we enjoy have changed since Thatcher's era. Second homes, staying at somewhere to work. In the old days, you lived near where you worked, sure. One hoped. Yeah. Maybe we do need a different style of tenancy, and I call it a single person tenancy, a weekday workers tenancy, and a family tenancy, with different rights available to the tenants, and with similar different rights and obligations available on both sides. But we need a little bit more consultation. I mean, I would agree with Ryan completely. You have a tendency, particularly if you have a family in economic difficulties, to not want to raise their rent in line with market expectation to help out, but without realising that you may be making a problem for yourself if you want to sell the investment on later. Most responsible landlords, and I speak as the husband of one, will generally go and talk to the tenant directly and not through the agent. They'll go and view the property and inspect the property directly, and if they find the tenant's completely redecorated, they'll take into account the fact they've saved, as a landlord, they've saved that money and won't adjust the rent. So it's a matter of having an active relationship and dialogue with your tenants.
I think that's a very important point, and you'll have perhaps seen on previous programmes we've had people comment that actually the COVID situation caused many landlords and tenants to interact in a far better way. It's caused good communication, which is great news. And I do take Ryan's point that where people invest in even their rented property, it's great news for the landlord, because people are getting equity within their home one way or another, aren't they? So
adding value.
Yeah. Yeah, and I think, I really think the moral is here, if you're a good tenant, you'll probably get a good landlord, and if you're a good landlord, you'll probably get a good tenant, But anyway, David, your second question. If I transfer a completed development project undertaken by one of my subordinate companies, I'm presuming that's a group situation, to the head company in my group, are there any stamp duty or other taxation liabilities I should allow for?
Okay, so as a general principle, if you move properties around inside a group, there should be no taxation liabilities. So if I move an asset from subsidiary A to subsidiary B, we've got SDLT group relief there. We shouldn't have any taxation liabilities in terms of capital gains.
Sorry, can I just cut in there? What happens if at the point of completion, the value of that property escalates?
And that's the one situation where there may be corporation tax, because
right, okay.
Clearly we're talking about a development, it's been enhanced in value, and that will be a trading profit to that particular subsidiary. So when the transfer goes over, it has to go over at market value. It's that is tax exempt. The trading profit must be taken into account and corporation tax provided for.
Okay. So what will the top of the group do? Do some kind of charge downwards to?
Yeah, I mean, again, you can do management charges, you can do all kinds of things, but you have to make sure that they're fairly and reflective of services received by the subsidiary, and any other value added to the development by other group companies, for example, which is why, ironically, your accounting, your revenue accounting, as I call it, if you like, your profit and loss accounting has got to be tight, documented and accounted for. I mean, I'd just like to turn back to the group relief point, which is in the example, we're passing up from subsidiary to holding company. Were we passing to another subsidiary where there were already discussions with an outside party to sell that subsidiary with the investment in it, you wouldn't get group relief. That would be automatically denied.
Would that be in terms of all the taxation, stamp duty, the lot? Or?
It would certainly be in terms of the stamp duty and in terms of the capital gains. Bear in mind we've already been corporation tax on the development profit. What's little appreciated about that relief is that the no sell do not talk about selling period actually runs for 3 years. Right. So again, hypothetically, we've moved it across from subsidiary A to subsidiary B, and a couple of weeks later we're approached by an investment fund. We still get the group relief initially, but when that subsidiary leaves the group, 3 years later, doesn't matter how long later, we have a clawback of the original group relief claim because discussions, arrangements were in place before the end of the 3-year period.
Okay, well, just in the last 30 seconds, if you can oblige, what happens if it's transferred from what would be the development company, in other words, a trading company, I suppose, over to another subsidiary that's an investment arm?
Again, as we've just said, the trading profit, the uplift in value caused by the development will be taxed to corporation tax.
Even if it's going into an investment holding company?
The investment company has to acquire it at market value, whatever its current market value is at the date of transfer. So your development profit will be taxed there.
Okay, well, on that sad note, it draws our programme to a close. So big thank you to David Hanna. I hope you enjoyed your first time on Property Question Time.
I did, thank you. It's been a great pleasure.
Good. And Ryan Hughes, once again, thank you for travelling down to see us again. Always good answers to the questions. So thank you both very much indeed. David Hanna, of course, is chairman of Cornerstone Group, and Ryan is founder of the Mr. Investor brand. So thank you both very much indeed. I look forward to seeing you next time. I'm Stephen Galpin. Join me on Property Question Time next time.